Welcome to Taking Stock for the week ending the 5th of June 2026. I'm Charlie, and joining me today is Jason. How are you, Jason?
Very good, Charlie. It's been great.
Before we begin, a reminder that today's discussion is general in nature and does not consider your personal financial circumstances. Nothing we discuss should be taken as personal financial advice or as a recommendation to buy, hold, or sell any security. A reminder that our Masterclass Investor Outlook event is in less than 2 weeks on the 16th of June in Sydney and the 18th of June in Melbourne. We will hold a full day of education and insights. Please find out more if you are interested in attending and contact our membership service team or visit our website. Jason, markets have had plenty to digest this week as tensions in the Middle East re-escalated. Oil prices moved higher on concerns around supply disruptions, while investors also grappled with the inflationary implications of high energy prices.
Yeah, that's right, Charlie. Everything is all happening all over again, and the market's really trying to balance out two competing forces. On one hand, you've got geopolitical uncertainty, which would normally support traditional safe havens such as gold. On the other hand, we've got higher oil prices, and this is increasing the prospect of stickier inflation, which could push bond yields and the US dollar a lot higher. And this dynamic has caused some of the volatility across commodity markets as investors reassess the outlook for inflation and also interest rates.
That's right. It's also a reminder of how quickly sentiment can shift. Only a few weeks ago, investors were focused on rate cuts and a soft landing. Now the discussion has shifted back towards inflation risks, energy prices, and whether central banks may need to keep policy tighter for longer.
Yeah, and these macro themes dominate most of the headlines. You also have company execution, which ultimately remains the key driver from our perspective of longer term returns for equities. And this is evident in the first stock that we want to highlight this week, which is Pro Medicus. Despite all the noise around geopolitics, inflation, and on interest rates, the company simply continue to do what a high quality software business does, which is winning customers, retaining customers, and also expanding some of those existing relationships.
The company also announced a new 7-year contract with Tidal Health alongside contract renewals with Allegheny Health Network and the Ohio State University Wexner Medical Center. Importantly, these weren't simple renewals. They were included broader adoption of the Visage platform, higher transaction minimums, and increased pricing.
And I think this is the key takeaway, Charlie. When investors analyze software businesses, they generally want evidence of three things: customer retention, pricing power, and also expansion within the existing customer ecosystem. And Prometic has delivered all three in the last couple of trading updates. The company continues to deepen some of those relationships with major healthcare providers, which is a bonus. And this is broadening the platform adoption that we see in North America.
The market clearly liked the update. Shares responded positively, and total contract renewals announced during FY26 now sit at approximately $141 million.
Yeah, the contracts also reinforce something that we've discussed previously, which is many software businesses can win customers, but the real litmus test is can they keep those customers if those customers actually have an opportunity to leave. So we want to see switching costs being very high. The fact that these healthcare providers are renewing while also simultaneously expanding usage suggests that Pro Medicus continues to possess some of the strong competitive advantages that we seek in a growth company. So few investors would dispute the quality of the business, and the question now remains around valuation.
Moving to Northern Star, the company released its annual resources and reserves update, with total mineral resources increasing 26% to 88.9 million ounces and reserves increasing 27% to 28.4 million ounces. The standout contributor was Heavy, acquired through the Degrade transaction, which now contains 13.2 million ounces of resources.
Yeah, the update reinforces Northern Star's high quality asset base. And what's arguably more important is the timing around some of these updates. The announcement also came shortly after Elliott Investment Management, which is a US fund. They disclosed a stake worth around $1 billion and publicly called for a strategic review of Northern Star.
Yeah, and again, the market took notice here. Shares rallied strongly following Elliott's disclosure and reveal of that presentation in which they detail how Northern Star should go about reviewing their operations and
Mm.
suggests that investors should be more involved as a catalyst for change here.
Yeah, and this is really where the debate sits around today. The discussion isn't really about asset quality. I think the real debate is whether management can convert some of those assets into stronger returns for shareholders. The resource update obviously reinforces asset quality, while Elliott really tries to focus on management's execution.
Our final stock highlight today is Brambles, BXB. Following a review, we've decided to transition Brambles from star growth to borderline star growth status. The decision follows the company's recent operational downgrade linked to disruption within its US repair network.
Yeah, the surprise downgrade really was a bit of a disappointment, Charlie. Management reduced FY26 underlying profit growth guidance from around 8 to 11% down to 3 and 5% after two subcontractors exited the repair network in the US much earlier than expected. The disruption created higher repair, freight, and also handling costs across a pretty significant portion of the US business.
Yeah, and investors reacted pretty swiftly here. The shares fell around 20%, reflecting concerns around earnings visibility and margins.
Yeah, and the interesting takeaway is this doesn't really suddenly make Brambles a poor business. If you think about the core CHEP franchise, it remains the global leader in pallet pooling with strong customer relations, resilient cash flows, and also exposure to pretty defensive consumer supply chains. However, the downgrade does highlight greater operational risk than many investors anticipated, and the company remains high quality from our perspective. But the slower earnings growth, subcontractor risk, and also reduced margin visibility means it no longer comfortably satisfies our star growth criteria.
That's right. And we'll be watching whether or not to see margins can recover through FY27. For Under the Microscope this week, we're staying with Northern Star. The stock captures several major themes currently influencing markets: elevated gold prices, activist involvement, management execution, and asset quality.
From our perspective, Northern Star presents a pretty fascinating investment debate. On one hand, the company controls one of the strongest gold asset portfolios in Australia. The largest resource and also reserve updates only strengthen this argument. The asset base is clearly attractive, particularly with gold prices near record highs.
Yet the market's focus has increasingly shifted away from the assets themselves. Why is that, Jason?
Well, I think investors are asking whether those assets are being managed as effectively as they can be. Elliott Management's criticism isn't about asset quality, but whether operational performance and shareholder returns have matched the quality of those assets. And I think this is the pretty important distinction.
Yeah, and that's what makes activist involvement interesting.
Hmm.
Activists typically emerge when they believe there's a disconnect between what a company owns and what the shareholders are receiving in terms of returns.
That's right. The company is also searching for a new chief executive, which adds another layer of complexity to this story. The incoming CEO inherits pretty favorable industry conditions. The challenge will be demonstrating improved operational discipline, stronger capital asset allocation, and also consistent delivery against the market's increased expectations. Ultimately, investors don't get paid because gold exists in the ground. They get paid when management converts some of those ounces into production, cash flow, and obviously returns.
And that's why Northern Star is our stock of the week. The opportunity here is undoubtedly obvious. The
Mm.
assets are um, the best in their class. The gold price has been supportive, generally speaking, and activist involvement may act as a true catalyst here. The risk is that execution still needs to improve, and there's a lot that needs to be changed and is yet to be seen at this point. For
Mm.
investors, it's a useful reminder that asset quality and management quality are not the same thing. Question of the week. What makes a turnaround investable? So again, highly relevant to our Northern Star discussion.
Mm.
Two companies that have recently held strategy days were Treasury Wine Estates, who own the Penfolds brand, and Endeavour Group, who own the Dan Murphy's brand. Both are attempting to improve performance, but investors shouldn't automatically assume that every turnaround plan will succeed.
That's right, Charlie. And it just so coincides that both of these companies operate within the liquor space. So that's pretty interesting. I like to think about turnarounds as a three-step process. First, management needs to identify the problem and in an honest manner. Second, they need a credible strategy in order to address that problem. And third, and most important, I think they need to really execute. So investors often become excited by presentations and targets, but turnarounds are measured by actual results. And this is what everybody's waiting to see from these two companies.
Yeah, and let's start with Treasury Wine Estates. Management's new Ascent strategy focuses on simplifying the portfolio, investing behind priority brands like Penfolds, improving the supply chain, and delivering approximately $100 million of annual cost savings. The markets responded positively to this recent announcement.
Yeah, and I think that's rightly so. The share price has been underwater for a very long time, and the strategy appears pretty logical now, given hence why we've got some positive sentiment coming in. Management has clearly identified several areas requiring improvement, including the American business, inventory management, and also addressing some of the complexity within its wine portfolio. The real challenge is that several of these need to go right simultaneously. Treasury really needs to improve execution while also navigating some of the challenges in the global wine market, like we see in China and also in Europe as well. And that's why I would classify it as a medium probability turnaround. There's certainly upside if management executes successfully, but there's also several external factors outside of management's control.
Endeavour presents a somewhat different situation. Management have identified issues around pricing. They believe that they've not provided the value perception that customers have come to expect from a brand like Dan Murphy's. And they've also increased their business complexity by branching out into private brand labels. The strategy focuses on restoring competitiveness, particularly price competitiveness and market share leadership at Dan Murphy's, simplifying operations and investing more effectively across the hotels division in particular, which has delivered better growth and better returns in recent years.
So if we weigh up a lot of those factors, Charlie, I think it would be fair to probably rate Endeavour as a slightly higher probability turnaround based on those reasons. And many of them rely on some of the key levers, which include operational efficiency, and this sits directly within management's control. So most of these key levers sit within the control, we think there's a higher probability of success, but that does not mean it is guaranteed. And it does mean management will have greater control, but we still need a lot of things to go right in order for that to really recover.
The risk, of course, and this is something analysts have rightly pointed out, is that restoring competitiveness means that in the near term, Endeavour is going to have a bit of a hit on their margins and their earnings short term. But CEO Jane Herdlicker, sorry, believes that this is the right long-term strategy to restore growth and restore better returns at this business.
Yeah, it's probably one of that short-term pain for long-term gain type of a scenario where management really needs to demonstrate progress through increased sales margins and cash flow over the longer term, and then take a little bit of that margin hit in the short term.
So what's the key lesson here for investors, Jason?
Well, turnarounds are always very difficult. So don't just buy a turnaround because management has presented a set of flashy plans that really pulls you in. I think the investable point comes when evidence emerges that the plan is working. Look for improving sales trends, cleaner inventory, cost savings being delivered on schedule, stronger cash generation, and management consistently doing what they say they will do.
That brings us to the end of this week's episode of Taking Stock. Thank you, Jason.
Thanks for having me, Charlie. It's been a pleasure to be on.
Until next time, have a happy, healthy, and great week ahead.